Hello, everyone. Welcome back to the RationalInvestor.com's Weekend Frivolity. This is our Broiler Chicken show. Looks like we're live on YouTube, so that's good to see. This is our sort of free broadcast that we do on the heels of the Level 1 program. They just did their strategic planning module, which of course is a very, very deep, thick module. Obviously, tough to become a complete strategic planner in this world in 1 week. And you may even have to review this material repeatedly. So I can completely understand. We sort of warned you guys last week. This is a very steep learning curve. And we're hitting you right between the eyes just to get it going. So I'm going to spend, I think, a good chunk of today's free YouTube video just talking a little bit about some of the concepts that we tried to convey through this past week, just to do a little bit of sort of updated context. And of course, keep in mind, these are a lot of concepts that Brian himself personally believes in. Actually, it was kind of cool. I went out and did just a quick search on the net for these 17.5-year cycles, and it turns out that there are quite a few other outside references to them, including actually one guy that I respect. He's getting pretty old, though. Guy by the name of Art Cashin actually made direct reference to these cycles one day on CNBC, and I included that video link in the school pinned messages. So check out that if you have some time. But in essence, we'll just jump right into it. I don't know whether we're going to have time to do things like crypto in earnest today. So I apologize. All the people on YouTube are going to be like, oh, man. But there hasn't been a heck of a lot of change to the backdrop. Maybe we'll take a quick overview of the big coins, but I haven't seen a heck of a lot of change over the past week. So it's not like the message has changed too much. So, just sort of a quick overview. The level oneers right now are hip deep in their strategic planning module. And how capital markets work, the different type of assets you can look at. And so we had a bunch of questions come out of this module. Grim did, I think, a fantastic job today with the class as sort of a group constructor. I think you're in great hands. And I'll just try and dovetail a little bit about some of the concepts that I heard talking about in questions. We introduce you to sort of, aside from planning, we won't get into planning and stuff like that in this conversation. This is more just about like sort of the bigger capital markets. Keep in mind, I wrote a lot of these modules about 3 or 4 years ago, and a lot of the actual physical numbers have changed. So some of them are slightly different. One thing I did hear people talking about, well, the commodities markets with the increase in the gold price over the past 10, 15 years, these numbers are kind of out of whack. Really, what I would suggest to all new people to the course, yes, these numbers probably could be updated, but we also give you this really cool website, which I absolutely love. Somebody found this for us back a few years ago. You can see this was this site in itself was published in October 2017, but I think I remember seeing it even before that. But this really is sort of the context of what I sort of wanted to drive home in that message about the relative sizes of the markets. And by all means, if you're watching on YouTube, take notes. You're trying to glean how do we look at assets in the marketplace. That's part of our sort of strategic planning. And I think this is it's an excellent sort of roadmap, and the whole message that I needed to convey, especially with people who are really crypto oriented, is I remember when I first got into the crypto space, people honestly believed at that point, that was back in like 2013, 2014, that crypto and Bitcoin could replace the fiat currency system. And even now, and I'm not quite sure when this was last updated, I think Bitcoin's market cap is higher than that now. And keep in mind, these things are constantly fluctuating. So I don't think it's so significant to get the exact number, but just to simply understand the context of the market. So, there's the world silver market. Obviously, the person who wrote this website kind of likes silver. Here is crypto, right, is sitting there. And then as we sort of zoom out, right, we actually see what some of these bigger markets are like. So, this is all this sort of floating currency out in the world. But we have to understand we live in a digital world. So most of the quote unquote money out there in the world actually is in this category, the global money supply. And you can see, I mean, we're talking like, well over $100 trillion, of which a very small portion of that is actually in physical money. A lot of it's just electronic. And then, of course, here's the debt market. Oh, Jesus, which is just absolutely staggering. I think they actually, yeah, here's the world stock markets. And actually, it's interesting. When I first started in this business back in the, I was born in 1970, my first job 88, but I, sort of started to learn about the markets through the 80s and stuff. The global stock markets, the equity markets were actually quite a bit smaller in proportion to the global debt markets. But you have to remember, especially like 1970s kind of mentality, people were still thinking about the Great Depression and they didn't really trust the stock market. As the baby boomers came on and they sort of bought into this, global, equity market, got out and owned stocks, the relative size of the stock market has increased quite a bit. But still, you can see the stock market is substantially smaller than the debt market. And then, to really actually like blow people's minds, you look at the derivatives markets, right? And the derivatives markets are just massive. And they just dwarf all of the other markets. But you have to understand that a big part of the derivatives market is simply hedging, and like a big part of the options market is just insurance policies, and most insurance policies expire worthless. So, and ideally, if you're buying insurance, you actually really don't want to collect on the insurance policy. You would prefer it expire worthless because that means a disaster didn't happen. But the simple message here, whether it be, global debt, whether it be, the actual fiat money supply, the stock markets, even, gold itself is only about, like 1/10 the size of the equity markets. And of course, it's not even close to, the size of the actual physical money supply or the debt markets. But the real message that I need for the level oneers to come away with is it realistic for cryptocurrency to actually take over the fiat currency system now? And you have to understand, it isn't physically possible. Maybe one day, Bitcoin does get to an absolutely massive market cap where it can compete. But as it stands right now, it's just not there. So that's the really big message that I needed for you guys to take away from this. Maybe we love crypto, maybe we believe in crypto, maybe we're going to, but let's put this into context. Is it realistic for crypto to take over even the job of the international money supply? And I just don't think it's quite there yet. So that's really the big message that I needed for us to take away from it. And of course, all the crypto enthusiast zealots that are watching this on YouTube, they're all going to downvote me because I said that. I'm sorry, but I really need for level oneers to understand that, relatively speaking, this is still a very, very small market. But the good part about it is it does mean that there is a lot of room to grow here. So that was a big thing that came out of today that I really wanted to clarify. Yeah, these numbers are a little bit off. I probably should go in and update them. But if you just want a nice sort of real-time measure, just pop on over to this site. And I think we even make it reference on the site just to give you those sort of relative sizes. Second thing that sort of jumped up out of today's class that I wanted to quickly touch on, we introduced you to sentiment indicators. And really at this point, we just simply want to, especially for new people to trading, we just simply want you to know that there are indicators out there that are very helpful in sort of telling you what the broader market is feeling. And one of the resources that I like to make reference to, which isn't available on TradingView, maybe one day TradingView can make it available to us, but that's this bullish percentage index. And you can calculate bullish percentage indexes on almost any market index, in that all it is it's just and I included for the level oneers, I even just grabbed the Google definition, right, of what bullish percentage is. I like to use stockcharts.com. I think John Murphy's done an excellent job building this site out as both an educational resource and a trading utility. And you can get this information for free, so you don't have to be a member. But level oneers, I included in this slideshow this link right here, NYSE Make It Market Internals, and that's basically all of these sentiment indicators, put call ratio, which we can't get on TradingView, and the bullish percentage indexes, which we can't get. I've included them, and a specific question. I'll put this link again in the lounge. I did put it in the level 1 Rocket Chat room, so by all means pull this down, and at the very least just bookmark it. The cool part about this is, you can come in here. This happens to be, I just double clicked on the NYSE bullish percentage right here. And here it is, NYSE. Basically, this is the New York Stock Exchange, all of the stocks listed on the New York Stock Exchange. How many of the stocks are registering bullish point and figure chart setups? And actually, we cover point and figure charting in level 2 because it's so significant historically. So I won't necessarily get into point and figure talk here. But the point of the matter here is that this is just basically a running gauge of how many stocks on the New York Stock Exchange are issuing bullish point and figure signals on any given day. And it works excellent as a nice sort of contrarian indicator. When this thing starts topping out and you start seeing divergences, well, you better be darn careful. And we just have a general rule. Usually market tops come in when bullish percentage gets above sort of 70-80%. So sitting at 62, I would consider this more of just sort of like a typical seasonal correction. And actually, I even put a tweet out before I left on my vacation that I think like May 1st, literally the stock market topped out. And you looked at the chart, it was just so cliche. Like there were so many reasons for the stock market to come down, and sure enough, the stock market's coming off. So here, nice divergence. It's come an awfully long way, maybe losing moving averages, market structure, whatever. This is sort of validating that sort of idea that, less stocks are bullish on the New York Stock Exchange. And I sort of did this as an experiment just to show you guys, because some people in the class were like, well, can you do this off of just one stock, or is it indexes? And if you go on stockcharts.com and you type in bullish percentage, you can see you can get bullish percentage indexes on like the energy sector, consumer discretionary, gold miners. There's the Dow Jones Industrial Index, right? So you can do them off of any index. And it's a very handy contrarian sentiment indicator that I'd like all of you guys to just get familiar with in this basic introductory program. And as I said just a moment ago, especially off of like this link, all you got to do is just Google bullish percentage index. It'll spit up the stockcharts.com link. And if you really want to go into depth, I mean, hell, they even do like an audio overview. They go, and this is one reason why I love stockcharts.com so much. I mean, they really go into detail about how you can use this information. So if you want to take the ball the next step and do a little bit more digging on bullish percentage, go for it. And of course, we can talk about it in broiler chickens and stuff like that, and daily brief videos and stuff. We do talk on the site a lot about TradingView tools. So I did see somebody in class say, well, I hear you guys talking about the VIX index, for example. That's another sentiment indicator. And, you know, I also have on this particular matrix, which I include in the education program. So you can pull up this grid. Things like new 52-week highs and new 52-week lows. That's a fantastic sentiment indicator. Market bottom, big old W. Market rallies, emming out, seasonal top, blah, 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 blah. Shouldn't surprise us. Great sentiment. And hopefully you see also, too, that bullish percentage index looks very similar to this new 52-week high, new 52-week lows list. As well, this is another study. This is the advanced decline line, the number of stocks advancing, heading up versus number of stocks heading down. And you can see this guy actually topped out back in January and has been in divergence basically this entire seasonal rally. Something's not right with this stock market. But the point of the matter here is like the VIX index, one of our site commentators, great guy, does lots and lots of trading with options. He loves following the VIX. In fact, he even trades options on the VIX. That's another tool. But the point here is when you in the daily brief and stuff, we talk lots about these because they're on TradingView. Unfortunately, I don't know why it is, but there are a lot more sentiment indicators that you can use, relationships, the number of stocks versus 50-day moving average, bullish or bearish, to 200 period, the summation index, McClellan oscillator, all this kind of fun stuff. But unfortunately, TradingView doesn't cover them, so we don't talk too much about them on the site. But I will make more reference to these on the daily brief, especially things like put call ratio. That's a really powerful tool. And maybe, you know, people at TradingView will ultimately add these tools to TradingView as well because they're extremely powerful. It's just we can't get them on TradingView, so we don't talk a lot about them. So, you know, all level oneers, be sure just to bookmark this page. And at the very least, all I want you to do is just sort of keep your eye on this and just how can I use tools that are not the actual stock index to sort of verify bull, bear? Do I see signs of divergence? You'll learn about divergences more in earnest in a couple of weeks when we get into TA. But the point here is that at this point in your education, this overview, strategic thinking, I just, you know, a lot of people that are new to the stock market and to trading and investing, they don't even realize this stuff even exists. So it's good to just, you know, break your cherry, just get this kind of conversation added to your sort of daily, weekly routine. Maybe on the weekends, you take a quick boo at these. Do you see M's? Do you see W's? That kind of stuff. Are we at extremes? That kind of stuff. Okay, so I wanted to talk a little bit about that. And by all means, if that didn't help and you're still confused, please PM me, PM Graham. I'm not quite sure who the TA is for the level 1 program this term. Alex was doing an excellent job previously. I don't know whether he is the TA this term, but I'm sure, you know, you level oneers, just ask Rimmer and he'll be able to tell you whoever the TA is there. We're here to help. And hopefully that helps a little bit with that conversation about sentiment indicators and various different ways you can check them out. All right, so let's put all that away. And we talked a little bit about assets, respective asset sizes. Look at that crazy derivatives market, eh? Just massive. And there's good old crypto. Imagine when crypto gets to the size of those derivatives markets. Ay. All right, so let's we talked a little bit about that, so let's put that away. We did have a couple questions about the long-term cycles, my 17.5-year fear greed cycles, through the class and sort of where are we now. I drew up this study back 2013-ish or so, 2014-ish. With this sort of thinking that, and hopefully, you know, I mean, it's a very powerful image. And I do know that some people, in fact, yeah, I can even just, let's take a screenshot of that just so anybody in the public, if you want it, you can have it. And I was actually, I think I even made reference earlier, I was exceedingly pleased to see how people, even in the stock market, that are respected figures in our, you know, community, whatever. I don't know whether that link works. Hopefully that link works for you guys. So, anybody on YouTube, if you want it, there it is. They talked extensively about these fear. Well, they don't call them fear greed cycles, but I thought it was kind of cool. Let's see if I can find it here. Um, when we got going on this most recent term, like I said, I just did a quick sort of Google search. I think it's this page over here and over here. Ooh, let's see if I did that right. Nope. Good try. Let's try again. Level 1, Q2. Oh, way up here. All right. One of these days I'll get this right. Hey, there we go. Ooh, Grimm's been putting out lots of stuff here. Whoop, July. Nope, did that wrong. 2018. Wow, gee whiz. One of these days I'll get this right. I was wondering why there's so much posted there. Okay, let's try this one. Survey says, hey, we got it. All right, that's it. Oh, actually, thought I put it in here. Where did I put it? Anyway, I did an update of where are we now. This was, like I said, as of 2013, 2014. And I did the channel off of these lows, connecting that low and that low. And then I just did the top of the channel off of the reactionary high here, which is interesting. I went and did up a new chart off of this same channel there to there. Basically the low of the Great Depression cycle and then the low of the post-Kennedy, I suppose, post-Nixon fear cycle bottom. And I think that this channel describes this relationship really well. I just thought for some reason I could have sworn I put those links somewhere. Maybe did I put them in the Q&A document? Isn't that odd? Anyway, I found a really, oh, you know where? I think I might even have it here. TRI school cycles. Yeah, here we go. So I thought it was fascinating. While I was sort of getting ready to for this new school term, back in I don't know what the date was. This was 2010. Mr. Cash, and there he is there, and geez, that's 7 or 8 years ago. He actually made reference specifically to this 17. He says 17.6 years. Which I find interesting. And he even says, add 2010. Oh, we got another 7, 8 years of this to go. So it's interesting how he made specific reference to this cycle here. And then there's also, I could have sworn I put this on the website, but I guess not. There's also a couple other people that made references to this 17 and a half year, 17.6 years, they like to call it. This guy's 17 and a half years. So there are a few other resources out there. People actually do make reference to these cycles. So it's not just crazy old Brian. This is kind of an interesting video. You have to sort of it's weird. And it might just because, you have to click on it and move it around a little bit to actually get the video to play. Anyway, so this guy here, he talks about the 17 and a half year cycle. So there are outside references to this. In years gone by, I would just say, well, I don't know. I've never heard anybody else talk about it, but I see it so often. It quite shocks me. But in essence, this green, or I don't know, that's teal. This yellow, that's typical sort of expansion phase of societies. And if you think about, all the kids that died on the beaches of Normandy and fought in the Second World War and all that, when they came back from World War II, they got going, the GI Bill, the big massive expansion in the United States economy. following the Second World War, coming out of the Great Depression. That was basically their expansion. And we like to call them the greatest generation. And think of George Bush Sr. He was a World War II fighter pilot. And that was sort of their generation coming back from the Second World War. Then sort of, and it's kind of weird, but following that expansion and then right into this peak, this was sort of like the days of Camelot, Kennedy, and all that. And sadly, of course, the not necessarily the greatest generation, but I suppose you could argue to a certain degree, that Kennedy, I think Kennedy, wasn't he a PT boat pilot in the Second World War? I think he fought in the Second World War. But anyway, the point of the matter is this was their economic expansion, and then this was them sort of leaving the economy, heading into retirement. And if all things were equal, if the United States currency was sort of stable and people had full faith in the currency and the equity markets did what they're supposed to do, then ironically enough, this is what should have happened. Because keep in mind, equity is supposed to be nothing more than a proxy on growth. So if the economy is growing, then the equity markets will expand. And then if the economy is shrinking, well, then equity markets have to shrink. The problem here, of course, is that, the public gets all rah-rah bullish, and it is a function of the economy. So as a result, in democratically elected societies, if the economy is shrinking in earnest, the odds are, if you are a democratically elected politician, you're not going to keep your job if you let this happen. And, the weird part about it is the last century, it was just common knowledge that equity was basically speculating on the growth of companies. Companies grow, companies shrink. Economies grow, economies shrink. And through the last century, it was commonplace. You want to invest in the stock market? Great, you could be a millionaire, but at the same time, too, you're basically gambling. But then the Great Depression happened, and of course, with all the social upheavals, especially Germany heading towards fascism, the socialist revolutions in Eastern Europe, the advent of workers' rights and trade unionism. The fabric of our society changed dramatically through the early part of the 20th century. So much so that, like the politician that was running the United States of America, his name was Herbert Hoover. And through this period, he even publicly came out and said, look, you want to play in the stock market? Great, but understand that stocks go up, stocks go down. And unfortunately, stocks, yes, they did go down through that very normal economic contraction. And he got run out of town on a rail. And, when I was growing up, Herbert Hoover was the worst villain in U.S. history. So, and it's ironic because every politician that's lived since Herbert Hoover has said, I am not going to be the next Herbert Hoover. I don't care what I have to do. I don't care. I am not going to be the next Herbert Hoover. And so we get into this sort of world of democratically elected politicians that just will not let the equity markets do what they actually normally want to do. So through this particular cycle, we had a politician by the name of Richard Nixon who basically said, uh-oh, here we go again. And he probably knew that these cycles were coming. And right through here, as the market was breaking, he decided to take the United States off of the gold standard, in essence, sacrificing the value of the US dollar to make sure that this thing didn't go down and he didn't get run out of town on a rail. And how ironic that he goes to all that effort, and yet he still gets run out of town on a rail due to his questionable politics. But anyway, that's sort of the funny irony of history, is that he went to all that effort to make sure that he wouldn't be run out of town on a rail, and he still was. But anyway, long and short of it here is the market didn't go down like it should have, because this thing over here was tinkered with. The actual, what do you measure these stock values in? They're measured in US dollars. And so if you devalue the value of the US dollar, you can prevent this thing from going down like this. So that's basically what happened through that cycle. Then the end of that cycle, the baby boomers, the next generation comes online. They join the workforce. The economy naturally expands, and this is what ends up happening, right? So we said, the guys who fought the Second World War, they came back and they hit the economy hard. The baby boomers came online and they hit the economy hard. Then the baby boomers sort of hit their peak earnings years, getting ready for retirement. And basically, we should have done exactly the same thing. But this is what should have happened if you leave your currency nice and stable. The value of the currency doesn't change. This is what happens when you say, okay, look, we'll try and run balanced budgets. But at the same time, too, if we have to spend more than we bring in, um, we'll let the value of the currency slide just so we can keep the economy going and keep these stock indexes relatively happy. This now is a world where we not only have sacrificed the value of the currency, but we've actually gone and just added just ridiculous amounts of debt to the equation. I would make the argument that had they sort of left things gold standard wise, this is the 2008 financial crisis. We should have come back down against the bottom of this channel and just consolidated nicely, like you see here, setting up for the next cycle. But they didn't. They went and printed a whole crap load of money, and just literally diluted the crap out of the currency. And so as a result, the reaction, of course, is that stocks, they want to sort of keep somewhat stable value. So if you dilute the shit out of your currency, excuse my French, then ironically enough, the actual natural reaction, if everything is supposed to stay the same, is actually prices of these crazy stocks go up. So that's what I think has sort of happened through here. This is a similar study, but I drew the top trend channel actually off of the peak. It's interesting how the trend channel itself didn't draw off of the peak, but drew off of this low here, which I find interesting. But if you actually break the cycles down, I was quite shocked at how very consistent this 17.5, 17.6, how long is 210 bars divided by 12? I think I did it. It came out to like 17.5. 17.5. And then also, too, if you think about it in simplest terms, what is a generation? What is a generational cycle? And usually they say a generation is like every 35 years. So if you take 35 years divided by 2, 17.5. And, as this image sort of points out, you get sort of a growth phase, and then you get a consolidation phase. Growth phase, consolidation phase. We should theoretically be leaving the consolidation phase and heading into our next growth phase. But the problem with this is that I don't know how this channel is going to react with the absolute insane dilution of this thing that measures these equity assets. And then, they always say, history never repeats itself, but it often rhymes. This is sort of that rhyming sort of thinking. It's never going to repeat itself exactly the same, but it is similar in behavioral patterns. I think also too, if we actually look at some of these cycles, theoretically this should, and I just drew these cycles right off of the 1929 stock market peak. Could this cycle have been a little bit earlier? Could have been a little bit later? That's a tough one. But it is interesting how 210 bars, 17.5 years seems to correspond with some pretty significant pivots. And so, but at the same time too, you could have said, okay, well, we're heading into a growth phase here, Brian. What is the pivot here? And then this one here, where we were at the end of a 17.5-year growth cycle, why didn't the market top on that exact day? Why did it actually top about a year or two later? Again, history's never exactly spot on repeat. It often rhymes. So I don't necessarily recommend people use this as the market will pivot on this exact date. I would prefer that you try and just step back and see the big picture, right? See these shifts in the way that markets behave over sort of decade long periods. Really, I guess you could argue 2 decades. Um, the other thing that I would sort of add to this conversation is, there was the 2008 financial asset crisis. I think if all things were equal, we should have come down to this trend channel line here, but quantitative easing propped the market up, and we got this dramatic reaction following quantitative easing. The only problem that I have with this is, and I was thinking, okay, now we're in a new cycle and it's just straight up from here. The only problem I have with this thinking is that usually economies move in this sort of 10-year business cycle sort of pattern. And if we go back decade out in, decade out, it's quite remarkable how this lasts about 10 years. And you could make the argument that if you looked at, maybe we should just pull that up here now. Where should I do this? Oh, we go now. I suppose we're gonna do a spider, so it's fine enough. 10 years to 10 years. Hopefully you can see, last major cycle pivot was 2009 was the bottom. So if it's 10 years in duration is the cycle expansion and the next cycle bottom, hopefully everybody can see we're due for some sort of pivot. And it's actually interesting to see how, where the hell is it? How everybody is now talking about how maybe the Fed's gone too far. And usually that's actually what happens. Over the past sort of 50 years, almost every recession has been caused because the Federal Reserve Board in the United States has raised interest rates too far and they've manufactured a recession. So, where are we in this cycle? My hunch and sort of what I'm telling people publicly is we're like, somewhere in here or somewhere in here. We're not in here. 2008, 2009, 2010 financial asset crisis. Oh, the sky's falling, right? That's what the bottom of the market looks like. And to get a sort of visual of what the Fed raising interest rates and how they actually cause this economic cycle to happen, think of it in simplest terms in that they say that the banks, of course, lead everything, right? And if the banks are profitable, then they're more likely to lend out to consumers and of course increase their profit margins. If the banks are unprofitable, they're likely to lay people off. They're likely to lend less money out. So the financial services industry is a huge sort of backbone to the sort of the whole economy. And this is a really good illustration. This is the last two economic cycles. Under sort of normal business conditions, like let's just pick anywhere sort of where after a meltdown, you'll notice that this is what's called the yield curve. You'll notice that yields on interest-bearing instruments rise as we go out over time. So that means that financial services industries, the banks, they will borrow on the short end of the curve and they will lend out to you and me, the public, on the long end of the curve. Think of like your house mortgages, car loans, all that kind of stuff. And in essence, this is their profit margin. In this kind of scenario, the banks are guaranteed to make money. They continually borrow on the short end. Every 90 days, they'll just keep rolling over their liabilities. And they lend out to the public on the long end, 20-year, 30-year mortgages, whatever, typical 10, 20-year mortgages. And this is their profit margin, and they do very well. And of course, if the banks do well quarter over quarter, year over year, then they're going to feel a little bit more comfortable about lending more money to the public, and then the money multiplier effect kicks in, and blah 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 blah. If the Fed wants to try and slow things down, because at the top of the economic cycle we get nasty things like inflation coming in, then the Fed will start raising this short-term borrowing cost, and they will, in essence, engineer a recession in the financial services industry. So if we look at economic tops, this is the dot-com boom, you'll notice that the curve looks very different. Right up at the top of the market, you can actually see at one point short end, right? All the financial services industry people borrowing at these rates and then lending out to the public. You can see that there's this little note inverted. This, in essence, in this kind of scenario, pretty much guarantees that the financial services are going to lose money. They're going to continually borrowing at the short end, and especially if they're borrowing like right in here, they're getting killed. And they're going to be lending out to the public at this. In essence, they're guaranteeing themselves losses. So what usually happens? Well, the banks go, holy crap, I don't want to do any business. I'm going to lose money. So I'm going to stop doing business. And in essence, that means less loans to the public, which means that things are contracting. It means that they're laying off people that work on their trading desks and stuff like that. And in essence, it generates a recession. And in essence, as this sort of economy cools down and the market breaks, you can see that instantly on that break, the Fed and the central bankers start saying, okay, inflation's not a concern. Stock markets start falling in earnest, and you can see how the short-term interest rates get lowered by the central bankers to the point where, okay, now the financial services industry at the bottom of the market is now guaranteed to make money if they do any business. And this is in essence how the economic cycle works. So into sort of 2002, 2003, market bottom following the dot-com boom, yield curve goes back to normal, and we start the game all over again. Then the economy starts heating up, right? Jobs numbers start going up. The Federal Reserve starts raising rates again. And as we get closer and closer to an economic top, there's that inversion signal again, i.e. the financial services industry are basically guaranteed to lose money. And the rule is that when we see this go inverted, there's usually about a 6-month window. And the irony of it all is that you know, the stock market and the talking heads on media, they can't think 6 months out. They're thinking today. What's going to happen today? Should I sell today and make $1 million today? Right? So ironically enough, what usually ends up happening is the yield curve inverts, which is a really good warning sign that trouble's about to happen. But the market just sort of keeps bumping along, and all the talking heads in the media go, oh, you're idiots. You don't know what you're talking about. Yeah, and then they forget about it. And then they're off chasing some other shiny object. And within 6 months, the market's rolling over and all hell's breaking loose. So, you know, at TRI, we need to watch this yield curve very closely. What does it look like now? And keep in mind, right, this is the 2008 financial asset crisis. When we look at this curve, do we say the financial services industry is going to make money or lose money? At this point, they're guaranteed to make money. And in fact, you know, the Fed was so desperate for people to borrow money, they were practically giving it away, right? Helicopter money, you hear all that kind of talk, right? So the economy expands, things are doing okay, but what does it look like now? Okay, well, interesting, as we're getting closer and closer to today, the yield curve is not inverted. It's still normal. But you can see the profit margins are getting squeezed, aren't they? I mean, it doesn't look like this, like, woohoo, huge profit margins. Now we're in an environment where things are getting pretty tight. And really, us at TRI, we're just simply watching and waiting for this curve to invert. That will be sort of our sign that we're getting really close to the end of this cycle. And you've probably seen me, and in essence, like we said, this is 2008 financial crisis. This is the dot-com boom. We got inversion signals well ahead of the events telling us, okay, get ready. Right now, we don't have that. So we shouldn't be thinking about economic crash. But at the same time, too, we should be cognizant that all it's going to take is these 30 years just to tick down a little bit, and this thing could go inverted very easily. Um, and we follow that on the site almost daily. We're talking about yield curve. Let's see. I think I can show you guys. Yield curve. You've probably seen me post this site on Twitter and stuff like that. Here is that yield curve analysis. You can see this orange line is that Fed funds, or basically the short-term rates. So 2 years, 5 years, 10 years are all below Fed funds. But there's 30 years, that long end of the curve, way, way out there. So it's still got some wiggle room before we go, quote unquote, inverted. But what is the general trend here? I see a heck of a lot of M's in yields, which means that they're heading in that direction. The question ultimately at this point, and this study right here is my sort of view on short-term interest rates. This line at the bottom here is the euro dollar contract, or the corporate interest rate market. And this is the Fed funds. And in essence, if these get too far spread apart, then it means the Fed is lagging the market and there's danger. So the fact that they're really nice and tight actually gives the market the ability, and it gives the Fed, they really want to, they can actually ease up a little bit. And just to give you an idea of how bad can get, in 2008 financial crisis, you see that this TED spread, this is what it used to be called, TED spread. We have to call it the Fed spread now, because it used to be the T-bills versus euro dollars. But you can see, here's 2007, 2008. You can see how that spread, if it gets above 1.0, then that means big troubles. So the point of the matter here is we're not in that kind of environment from sort of a credit squeeze perspective. So the Fed actually does have some wiggle room here now. We'll see how it goes. Of course, Mr. Trump and stuff, he's been screaming for the Fed to lower interest rates. Interestingly enough, with the corporate credit market, in its rate coming down quite a bit recently, that's all this kind of stuff you see on here. The Fed actually does have some wiggle room. And we're not in inversion just yet. So as a result, the way I would look at this is, more of sort of like a seasonal dip in the market, April, May versus like crash, right? There's an old cliche in the market that goes sell in May and walk away. But from what I'm seeing here, I don't see the signs of recession just as of yet. And I actually see that the Fed actually has some wiggle room here. I wouldn't be surprised if over the next 4 to 6 months, the Fed sort of says, well, okay, maybe we went a little bit too far, and we can actually lower rates. Usually they don't like to do that. They only like to lower interest rates when they really see financial calamity. And I think that might actually be driven more by sort of international politics, trade wars, all that kind of stuff, versus interest rates and like the yield curve inversion showing imminent signs of recession. Which is an interesting conversation unto itself, because I have had a few people on the site even talk a little bit about, and I kind of believe this to a certain degree too, coming out of the Great Depression, and that generation coming back from the Second World War, you'll notice how their market looked, where it sort of moved in big bursts, and then sharp little consolidations, and then bursts, and then sharp little consolidations, and then bursts. Could we be in that kind of market, kind of like what you saw in January, where you have just like sharp moves to the downside and then ratchet right back up? As long as the yield curve does not invert, then I think we're in that kind of environment where short-term sort of trade war kind of talk, shocks are going to ratchet the market. but we don't actually tip over officially into recession. It's going to take some time. And usually they say recessions happen in years that enter eights, nines, zeros, ones, and twos. So we're in year 9. Could this be a 0, 1, or 2? Yeah. Which means that the recession might not actually happen until, a couple of years from now. And it's dangerous, like predicting this is when the market will top, because kind of like these guys in here, if you called a top right in this and said, okay, the market's going to go straight down from here, the market actually went up like another full year following that pivot. That's why I don't like our students to use this as a technical timing tool. I just really need for you to see the big picture. What do fear cycles look like? Consolidations, and in this case, massive dilution of the currency. What do greed cycle look like? They look like just absolute face rips up. But I'm not convinced that we head into a face rip up, a massive growth phase, until we get on the other side of this economic cycle. Like we're sitting right up in here somewhere. I have to see that pivot come in. I have to see the recession come in, and then I'll know that, okay, we're ready to base, and equity should start really ramping up. So I hope that helps. I know that's an awfully big conversation. But the long and short of it here is, if we had left the purchasing power of the fiat currency system, and ironically enough, I don't think, had we left everything stable, we should have gone through like a Great Depression scenario. And my hunch is Bitcoin would have never come into existence. The fact that the central bankers sacrificed our currency, injected a massive amount of price inflation and lack of confidence in the fiat currency system, it actually led to the creation of Bitcoin, because people were like, enough is enough. We've had enough of you diluting this currency just to keep your banking system going. And we're going to create our own currency system that's not sort of manipulatable. So as a result, this scenario here gets awfully muddled, because really the question at the end of the day is, what is this being measured in? It's being measured in these things called dollars, and of course the value of each of these dollars is changing dramatically, just even on a daily basis. A really good sort of visualization of that is, this was the sort of the greatest generation, the baby boomers coming online through their fear cycle proxy market and the gold. And I've talked to the YouTube audience at length about this in the past. And lo and behold, this is this cycle's fear proxy, good old Bitcoin. And the similarities of these charts, in my opinion, are just stunning. So there's one other, like in the course, we talk about historically, before the days of Bitcoin, we would have just simply used this gold Dow ratio as sort of a measure of paper assets versus physical assets. The problem here with this scenario is that I think Bitcoin came along and basically ate gold's lunch. I think, let's see if I can show you that. Where the heck is it? Darn. I think this is it. And it kind of like, I think it irritated the gold bugs to no end. But, here is, if we go back to the cycle pivot, which was the fall of 2017, this green line is the US dollar index, if I'm not mistaken. Yeah, green. Do a little thicker there so you can see it. And you can see that in old cycles, if the US dollar index as a measure sort of for, fiat currency system, If it was heading down in value, gold would head up. Then something came along here in 2011. And you could actually make the argument that, here was the top in the US dollar index. This is Mr. Trump, of course, being elected, blah, blah, blah. Gold should have taken off here, but something came along and gobbled up a lot of that purchasing power. And this is our beloved Bitcoin here. So at some point down the road, we might have to ask ourselves, and sadly for all the gold bugs, right? They expected this was supposed to be where this top in the US dollar index, fear cycle apex, this was supposed to be when gold was supposed to shine. And gold should have gotten a lot of buying interest. And, like that last fear cycle apex, like I told you, through that cycle, gold went absolutely bananas. But the irony of it all is that this crazy thing called Bitcoin came along and it gobbled up a lot of the purchasing power that should have bid up gold historically, but the money went into Bitcoin. So, this is a study over the 20th century of that gold versus Dow relationship. And, this is the 1929 stock market peak where it took a lot of gold to buy one Dow Jones Industrial unit. This is the depression and the bottom of the stock market where it only took like 1 ounce of gold to buy, or I guess 2 ounces of gold to buy a Dow Jones Industrial unit. This is the days of Camelot, right? And Kennedy, where it took like 20, 30 ounces of gold to buy one Dow Jones Industrial unit. This is 1980, right? That was this peak here, that fear cycle apex, where it took only 1 ounce of gold to buy Dow Jones Industrial unit. There's the dot-com boom, and hopefully what you see is just a nice simple sine wave. This is basically how this fear greed cycle works. The interesting thing is through the 2008 financial asset crisis, if we actually look at that Dow Gold chart in earnest, and I think I have it on here, right here. So there is that financial asset crisis, right? 2008, 2007, 2008. The injection of fiat or quantitative easing, blah, 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 all that. And we hit a low of like 6.3 ounces of gold to buy one Dow Jones Industrial unit. And as I had said just a moment ago, one of the reasons why gold, I think, didn't perform where this thing should have been lower was that Bitcoin came along and gobbled up a lot of that purchasing power. So sadly, of course, when Bitcoin went from like 1,000 up to 20,000, which is very similar. This was like, 100 up to 800. When Bitcoin did do that, you can see that gold just really didn't get that much of a bid. So, there is 2008. If we look at the entire history of Bitcoin, you can literally see, here is 2008 financial asset crisis right in here. This is where gold should have gone absolutely insane, but it only like doubled, right? Where did all the money go? Well, it looks to me like a lot of the money went into this crazy Bitcoin thing. And then, of course, when Bitcoin went absolutely parabolic, right? This is historically where gold should have taken off and just gone absolutely bananas. But unfortunately for the gold bugs, all the money went into Bitcoin. So as a result, this study, I think, we might even look back 100 years from now and see that Bitcoin actually basically replaced gold as the ultimate fear asset cycle proxy. That may actually be the case. And I would make an argument, if you believe in Bitcoin, you believe in the blockchain, you believe in the sort of the unmanipulatable characteristics of Bitcoin, then it would make sense to me that, and what I wouldn't be surprised to see happen is that at some point down the road, gold and Bitcoin all get sort of morphed into sort of one sort of, fear asset proxy. It'd be interesting to take this gold and Bitcoin and morph them together into an index and see what that looks like relative to the US dollar through this cycle. And my hunch is that peak probably was that cycle's apex. If looking back in hindsight, I have a funny feeling that that's what's going to happen. Okay, so hopefully that helps our level oneers sort of see those pictures a little bit better. I know this is a very, very difficult, very big concept to wrap your head around. I would prefer, though, that you just simply see the forest through the trees. You don't necessarily have to use this kind of concept to time your purchases. Okay, this is exactly when you buy, this is exactly when you sell, but just that you sort of see the bigger picture context of what's going on in the world. And the people that are in the level 1 course, if you still have lingering questions, you can always just PM me and we can talk a little bit more about this, but hopefully that helps sort of dovetail with everything that Grim talked about in today's class. Okay, I think so. We'll put that to bed. We talked a little bit about the sentiment indicators. So we can put that screen away. We talked a little bit about gold and Bitcoin, so we can put that away. We talked about these long-term demographic cycles. We can put that away. We talked about the economic cycles. We can put that away. Do we want to get into yield Bitcoin here? Let's see. We talked about interest rates, so we can put that away. Long-term cycle. I think we could probably put that away for now. Okay. And by all means, didn't see any follow-up questions. Let's go over on YouTube and see what people are asking about there. FE Hero, when is beginning of level 3? Well, like I came back from vacation last Saturday, Sunday. And I was thinking that all the emails and introductions and stuff for level 3 went out this week, but they didn't. So we'll send them out literally tonight. So your first class for level 3, whoever is registered, should be, and I think actually we even put it in the calendar. Let's see, how do we do this? If we go level 3, I don't know whether this is on here. Yeah, there we go. So you can see we've set up the level 2s. They just got going. First official class for God mode, level 3, is June 1st. So FE Hero, hopefully that helps you. And remember, our week 1 is all just sort of, meet and greet, get back in the saddle. What are the stuff we're going to do? So there isn't really any homework specifically for this week. It's just to get everybody sort of settled. So first class for this upcoming level 3 term is this Friday. Hopefully that helps answer that question. Let's see. Okay, we might as well do a little bit of Bitcoin while we're here. As I sort of talked about recently, let's maybe pull this page up here just so it's not too late, Josh. If you want to PM Julian, you can ask him how to go about doing that. Let's go in here. All right. So, all right. Yeah, I just noticed that with the Brave, and I don't know, we got a few people in the Hangout here. I'm not really talking to anybody today, but I noticed that when I load the Hangouts off of Brave browser, I can't hear the people that join the Hangout, so I have to use Google Chrome. Somebody was asking about why I'm not doing this off of the Brave browser. So, okay, so we talked about this last week. Not a heck of a lot of change in this current weekly bar. It is Sunday. Of course, I'm going to be heading off to Liam here shortly. And I always caution people, you never know what the hell's going to happen late on a Sunday. But I will say that tomorrow is a holiday in the United States. So actually, I wouldn't be surprised if we see some fireworks here through sort of overnight holiday session. So be prepared. But on balance, if we look at these higher time frame charts, I don't see any signs of failure here. Denia, you are messaging me. What's on your mind, dear? Are you a man or a woman? I'm not quite sure. Denia? I suppose I could call a boy a deer. I'm old enough. My son's like, oh, geez, he's going to be 19 this fall. So all you guys, I consider my kiddos. Anyway, ask your question, Denia, and I'll be more than happy to try and answer. So just big picture off of things like Bitcoin, Ethereum, Litecoin. I don't see any signs of failure yet. If we do happen to finish the week as it is on Bitcoin and Ethereum, we might be painting what are called inside bars. And very simply put, anybody who's studied fractals, let me hide that. How do we do that? There we go. Get rid of that. This could potentially create a fractal. Really cool tool on TradingView to try and see that is you can go on in the indicators. Actually, this might need to be updated. Hold on a second. Well, actually, I could probably show you right off of here. BTC USD. And to see fractals in the market, you can go into your indicator list on TradingView and type Williams. I think you just go William Fractal. Maybe you just go Fractal. There it is, Williams Fractal. And in essence, it will draw a little. It's awfully tough to see with the defaults. Maybe I'll change this. Get ready, watch your eyes. I'll change the background to well, no, what the heck, we'll just change these colors. I like the dark color so it doesn't fry you. But why don't we increase this to like say 20 points so you can really see it and make that really bold. I think we'll go like that. All right, so now you can see these are the bottom fractals, and we can do the tops. All right, so when a market, this is like, it's called the Williams fractal tool. You can find this on TradingView pretty easily. When the market makes a pattern that has sort of like one high and then another high and then a lower high, right? This is what's called a fractal. There are a lot of people in the world that like to have 5 bars to make the ultimate fractal formation. The easiest way I think that people can understand fractals is there's the best way to show you this. We just go where's the camera? Oops, flag. Hey, there we go. So you look at the maple leaf, or the Canadian flag. You can see this 1, 2, 3. That's a little fractal there. 1, 2, 3. That's a little fractal there. 1, 2, 3. That's a little fractal there. You can also think of these as like head and shoulders. Little head and shoulders pattern. Little head and shoulders. Little head and shoulders. And the really important thing is to understand that this is also a fractal. All these 3 little fractals inside all make up one big fractal. And that's sort of agnostic of time, in that quite often, like if we see a big head and shoulders pattern off like a daily or a weekly price chart, when we zoom in to maybe like a hourly or 15-minute or 5-minute or 1-minute, whatever, you often see these little sort of fractal patterns within the bigger fractal patterns. And that's sort of how how nature works, right? Is it creates a basic building block framework and then just exponentially builds on that. So, like all our conversations about things like seashells and how they are just, they're in essence the exact same pattern. And, you think of fib ratios and stuff. They're the same pattern, just built on top of each other over and over and over and over, right? And if we think about things like the fib spiral in nature, same thing, right? It's the same simple pattern, just compounded on itself over and over and over and over and over. So the point I'm trying to make here, very long-winded, is one sort of technique that we use to learn how markets transition from bull to bear is this concept called the fractal. And so right now, we would get a fractal top signal if this bar closes the way that it is inside here, and then we actually head below this low next week. So we're not going to get any sort of fractally signals this week and not till the end of today. But we'll watch next week's bar, and we might get our sort of first signs of failure if we go through these lows next week. Right now, the absolute most we call this, we just simply call it an inside bar. And the easiest way, of course, for this inside bar to be broken is just head up and break this high up here. And we do that. And if it happens today, then the inside bar sort of idea, the fractal idea, completely evaporates. And that might happen. I mean, we see some crazy stuff here on Sundays. Don't get me wrong. It's still very early in the day. But as it stands right now, if I was sort of watching for levels, and you probably heard me say this before, we get these sort of bull-bear battle lines, right? So if we finish the week, beep, right here, we very, very simply put, have a bull-bear battle line, where if the market can get up through the top here, then we know the bulls won. On a move above. And if we break back below this low, then we know the bears won. And right now, they're at war with each other. Who's in control? We should probably also mention just the simple fact that the moving averages that we like to use to sort of measure trend have turned back to the bull side. Specifically, I like to follow the 13 EMA and the 30 SMA off the weekly charts, and you can see they turned bearish here on this ultimate failure back March of last year. And we've just been grinding through the bear here until boom, just before I left for vacation. And I remember talking to you guys about those videos. In fact, we have a really cool little sort of matrix that we've set up here for crypto. We actually sort of plotted, and we watched these as one at a time. They all slowly started to turn up. And you remember Tron was the first one. And it looks like Tron's getting ready to rock and roll here for another leg higher. So that's encouraging. And on the site recently, I distinctly remember saying that, I did a video with Da Vinci a while ago where, the market had moved up here, but it moved very far away from its W bottom. And the market that actually I was very interested in at that point when I did the video was Ethereum, because it was just breaking away from its W down here. And it's actually really cool because I run a weekly commodity trend service that I used to do on my 1980s website, and we're finally getting it set up to be tracked on the new TRI site. And I've been working with people scripting and stuff. I've got sort of a universe of about 250 issues here that I like to follow: commodities, ETFs, large caps, canceling stocks, venture cap stocks. One of our senior site members and I run a little penny options portfolio. And actually, I've recently added crypto in here. And of the entire universe, you can see there aren't that many that are actually going to spit out buy signals. Buy signals don't happen every day, and they really shouldn't, right? If you can understand this image, we really only want to be investing in assets just as they're sort of turning their corner and they're starting to issue buy signals, and they've got a long, long way to go just to get back to the mean. And we use the 50% rule as our mean. So we calculate running 50% rules, and then what is that sort of moving average relationship doing? And only when markets are substantially below their 50% rule and they've given that moving average cross do we actually start getting super bullish, buy signals. And I thought it's fascinating because right now, as it stands, we have one crypto asset that's actually giving a buy signal, and it's Ethereum. Okay. None of the blue chip stocks, none of the IBMs or the Dow Jones Industrial Averages, none of them are issuing buy signals, but Ethereum is. Why? Well, actually, there's the wrong screen. I should put that away. If we look at Ethereum, you can see that there is that moving average cross. And if we just do simple 50% rules, just even over the past year or so, you can see that we're still far, far below where that buy signal is. Or excuse me, where that just simple price objective should be. Now it's moving far away, so it's getting to the point where it's starting to be unattractive. But a week or so ago, oh my God, this was an absolute fantastic buy. And I really like the look of this Ethereum here. I mean, I can't be a buyer here, but I definitely love the buy off the bottom there. And Bitcoin had its bottom at about $4,000 and it doubled. So this Ethereum's double bottoms at about 160, 170. Could we see a stab up into 340, 350 area here to validate that doubling? Sure. Well, it wouldn't surprise me at all. So, for whatever it's worth on the site, a couple coins that we're really interested in. This Stellar Lumen looks like it's just getting ready to try and turn the corner here. You can see the moving averages haven't quite turned yet. Hopefully everybody, we talked about the fractal, so hopefully everybody can see that fractally type action there. And it's a coin that basically, 50% rules, sitting at 12 cents, 50% rules 21. If I can get a buy-in, 10, 11 kind of cents area, well, just even this 50% tag's a double. So it's looking very interesting. It's getting ready to turn. It hasn't turned just yet. I distinctly remember before I went on vacation, I said, if I was going to trade and take a shot on anything, this silly Ripple was down at the bottom end of its range here. Taking shots against the low end of the range turned out to actually be a half decent idea. But you can see it's trying desperately to turn the corner here, and hopefully you see W's are trying to form here. So let's keep an eye on good old Cripple. Looks like it's trying to turn the corner. I think it's critical in this kind of market state, while we're still sort of going through the thawing of the crypto winter, I think it's absolutely critical that you measure your asset versus USD, especially with, sort of Bitcoin, like almost, I mean, hell, another $1,000 and this will be a triple off the bottoms there. I think it's dangerous judging your investment idea relative to Bitcoins, because look at the volatility in the Bitcoin. And this is the one reason why I don't know whether we're ready for Bitcoin to really replace the fiat currency system. I can tell you right now, as a business owner operator, it is very difficult. And I went through all this mess through here. It is very difficult to price your asset in Bitcoins, because what the hell is the price of Bitcoin? It's, this may look really small, but this is literally doubling, I mean, this is, okay, the price of your product is $1. Now it's 50 cents. Now it's $1. Now it's 50 cents. And, here we are again. And ironically enough, if the powers that be that don't want Bitcoin to be mass adopted and everybody stop using fiat currency and start using Bitcoin to price their products. This is exactly what they want to do to make sure that the society doesn't switch to Bitcoin, is inject a whole shitload of volatility in here. And then you don't know what the hell your assets worth on a daily basis. And like I said, I've tried to run a business just pricing in Bitcoin, and there's no consistency in the pricing. So, if you are interested in investing in these various ideas and you're hunting W's and all that, I think it behooves you to look at your asset versus US dollars. Now, I see somebody over there, kind of as a joke, I hope, said, all right, I'm all in on Ethereum. Keep in mind, is Ethereum at the bottom? Is it at the W right now? No, right? Your W probably comes in on a break of these highs. What is that? That's 160.95. And here we are at 253. So, by all means, you're coming very, very late to the party here on Ethereum, Mr. Heinz de Broth and Nats Cats, if I pronounce that correctly. Silly boy or girl or whatever you are. So, what I'm most interested in is, can I get in where it's appropriate to take the risk? And now this guy's already starting to move away from there. So let's not be FOMO chasers, please. We're playing those W's. So I'm more than happy to take a look at your ideas. But I think, as I've sort of said over the past 6-8 months, it's critical that you take a look at these things versus USD, not just Bitcoin. Okay, so somebody on the TRI Lounge has asked me to take a look at Storm. So let's go take a look at Storm versus USD. Can we? Oh, okay, so calculator versus trading view. I look at an asset like this, and first and foremost, the thing I have to ask is, are you walking into a trap? Who can answer that for me? Are you FOMOing here? Are you coming into this market after it's had its move? Are you, oh my God, I'm missing out. Oh, everybody else is getting rich, but not me. Who asked about this? David Davis, what do you think? Are you FOMOing here? David Davis, are you around? Okay, Dinia, I'm going to have to say, let's ask Julie together how to handle this. There you go, Dinia. All right, so the point of the matter here is this actually looks very attractive. You're not walking into a trap. Really, I wouldn't have a problem, little old lady, Nanny Nibbles, actually just putting yourself on a little nibbling campaign once we sort of got down into these levels. And if you just say bought like 1% or so and you spaced it over like, say, 3-6 month period, maybe you bought a little bit here, maybe you bought a little bit on this potential W, you were thinking that's the bottom. You could buy a little bit more. Nothing wrong with that. Totally fine. Oh, yeah, I'm supposed to say that. I keep forgetting that, right? And of course, we're about 2 hours into this. So, holy Jesus, look at the time. I got to wind this up soon anyway. But yeah, as Alicia says, you're supposed to, I think somebody else uses that term smash, so I'm not going to say that. I'm going to say politely tap the like button. How's that? But yeah, if you like this video, hit the like button, subscribe. Also, I noticed we have a free 7-day trial on the site, and a lot of people are signing up for those trials, so that's good. I also noticed too, and this is a little bit scary, but there are people who are actually blatantly copying our material and not even rebranding it as their own. And please understand, everybody, and I think I'm going to have to put these copyrights and disclaimers across all of this stuff now, which I kind of hoped that people would have the best intentions, but just be aware, anybody who is watching this, all of the content that you see at TRI is copyright protected. I suppose we can put a big, just to be formal, what is it? It's like, it's the @C thing. I don't even know what the heck it is on the keyboard. But any dissemination, reproduction, or retransmission of this material is strictly prohibited without the express consent of the rational investor. So we will say copyright. Right. Oh, I actually did it as a symbol. Oh, and maybe this. It's weird how you have to update all this stuff all the time. Reload that. But please understand, everybody. Unless you actually have our express permission, you're not allowed to copy this stuff. Okay, just be good citizens of the world. Copyright. So, and from what I understand, as soon as I put this on here, that actually legally is enough to actually say that you're not allowed to copyright it. So you're not allowed to copy it blatantly. So anyway, I have to get into the habit of saying that every single one of these videos. So anyway, back to our conversation. Coming in against the bottom end range, love it. What would be really cool is to actually get, like, what is the fundamental drivers? Somebody asked me to take a look at this. David Davis, like, what fundamentally is going on here? They got a new product. They got a new service. Is there something that, bigger, better mousetrap? I don't know. Technically, you look at something like this, and of course, we love W's. Little concerned that I went to a new low here. That's a little bit suspicious. Beautiful OBV. Money is just piling into this thing. It almost looks to me like they tried to establish a base here, and they were getting to ramp this thing, rock and roll it, and then something just pooped on the market there through April. I do know that Bittrex, for example, I think it's Bittrex, one of them, is going through a whole bunch more of this delisting stuff. So this could be sort of, throw everything out, baby out with the bathwater kind of idea. Not even going to hold anything in altcoin land. I suppose one could argue, like I said just a moment ago, it sure looked to me like they were trying to base this thing. Money was coming in, nice W's, lots and lots of upside potential, and just one more FU just to make sure we've cleaned out all the chumps. And in a sad sort of way, that is such a typical shitcoin, altcoin kind of. Keep in mind, people, this is the ultimate venture capital space. This is the ultimate unregulated, we're going to mess around with you as much as we can environment, right? And I've seen historically lots and lots of examples of them just going out, washing the lows, and then putting in a base and it taking off. That's one reason why I kind of like the little old lady approach to deep venture capital. At the same time, too, had you had taken like these W's, I don't know whether you would have gotten a double. That's 0.029-ish, call it 0.03. So you didn't get a double out of it. So, you wouldn't be sitting there going, sell have on a double kind of idea. I guess the way I would look at this is think of sort of like saucer bottom. Quite often it takes a while for these things to sort of ultimately turn, something like that. So you see it sort of entered in its sort of final saucery sort of phase. And if you do just like a 50% rule, half of that saucer bottom. Is this the ultimate low? Just keep in mind it did just make a new low. So maybe that's our ultimate pivot. Maybe we're looking something like that. I got to say, with this OBV looking the way that it is, smart money is accumulating in here. No doubt about it. I would like to see higher volume bars, so it's pretty important that we take this volume bar out. Could this be accumulation phase for me? Nanny nibbles, just slowly adding. Sure, looks good. Is this, investment grade? The trend is up. It's straight up from here, kind of like what we saw on things like XRP and that lumens. The trend itself has not actually turned up just yet. It's trying to turn. The fact that it made a new low here, though, unfortunately leads me to believe that, maybe we rally up to this level in here, then have to come back down, and we sort of do something like that. Maybe it looks like this. Who knows? But until we actually start getting those weekly W's coming in that hold, I think, unfortunately, we're still waiting. And as you sort of see with the moving averages, the trend is still technically down. I ideally, in sort of our sort of Bitcoin trading plan, is kind of want to see these cross bullishly. And then once the moving averages cross bullishly, then you hunt for consolidations to frame your trades. So a little bit early to call the bottom here yet. It's encouraging price action. Like I said, those people that are like nanny nibbling, I don't have a problem with you just nibbling away on this. You're not chasing the top. You're not walking into a trap. There is lots and lots of upside. And somebody's saying there's VC money coming in and supporting these guys. That's ideally what you want to see. So you're a bit early. Just be patient. Just let this let the moving averages cross, let this develop. Yeah, so that's probably how I would look at that. Lots of positives. I see lots of positives here. Okay, and somebody's asking about BAT. I don't know what's going on there. BAT USD. Where do you want to look at this? Binance? Everybody loves Binance. There's good old Bitterix. Oh boy, really? Couldn't touch that with a 10-foot pole. Looks like you already saw the rally. Bitfinex. Let's see what this one looks like. Oh, that's a little better. Okay, so actually this is a good example of what I was just talking about. So you might see this on Storm, right? Where, they take it to new lows, they ramp it up. Moving averages across bullishly. You could hunt like lower time frame long setups to trade that. But really, I think that the trade is actually going to start developing now. So moving averages crossed, reload zones. Boom. I would have no problem hunting long setups down in here, right? Against the original breakout, not a bad idea to maybe pull up like a daily chart, see if there's any price gaps or anything you can hunt down in here. Well, look at that. I see some gaps down in there. There's another gap right there. So, the cheap ass in me kind of wants to see the pullback down into reload zones here to try and get in off of the bottom end of the range. Since the moving averages have turned up, it's a bit more aggressive, but you could hunt trend continuation trades. So that's the bot, right? So we can go bot setup. All right, so we did 33, but no more than 66, so that's valid. And then you can go like so. And let's see, there's the 25 level. Ideally, I'd like to see one low, two lows, a third low, and really that would probably correspond with a nice trend line break here. All right, so there's your down trend line. It's potential right now. It hasn't been confirmed. So the best case scenario would be like one low, break here, 2 lows, 3 lows, and then I got a nice structure on the other side of that trend line. That would be sort of ideal scenario for trend continuation trades. So, definitely not coming in off cheap ass levels. If you're a cheap ass, then you're hunting bids off of, I think probably that gap there. That gap there. There's a cheeky little gap right there. Doesn't look like that's been filled in. And of course, if we change this to reload zone, what do you think the odds are that that's right in the reload zone? Probably pretty good. Oh, 78.6 right there. So there's also, look at that huge gap right there off of Mountain Man. So my knee-jerk reaction is this thing's in its sort of correction phase after a big run-up. If you think that this thing is going to continue and this is a bull flag AB equals CD, then hunt your bots. Really would like to see 3 higher lows and then a nice structure signal on the other side of this trend line. If you're a cheap ass and you want to work bids against the lows, then I really like sort of like this area, 17, 18 cents, and also this area here, 14, 15 cents for some stinky bids. And we could probably even sort of see this to a certain degree, boobity boo. And then boobity shmoo. See how that A, B, C, D is going to take us down into that area down there. So and nothing really for me to do here right now. Cheap ass bids, trend continuation bids. That's the way I'd be looking at that. Okay, you guys are getting all excited about big breakouts happening on Bitcoin. Ooh, look, isn't that funny how I talked about that earlier, right? I said, by the time the end of this day, everything could flip around. So you can see how easily the market is now rallying back up, and we might even get a nice little buy signal. Actually, this would be kind of cool to see on algos. Interesting. So algo flashed bull here, but that disappeared. But we're sitting very neutral right now. So nothing to do algo-wise for me. But interesting how they're going to try and break the top here. Kind of cool. Yeah. So off of hearing everybody talking about how we're getting big breakouts here. Actually, this is an interesting conversation unto itself. This was a bot setup that we sort of had, and I used to find this happen a lot when I was prop trading, where I'd set up my bot levels, and then Mountain Man would set up his 61.8, and so I'd be long off of this level, and he'd be short off of that level. Interesting how we had, and we talked about this on the show on Friday, we had the market run up to the bot level and move stop to scratch level. And in essence, all through here, I remember my co-host was thinking rather bearishly, and of course he's a bear by trade, so that makes sense. And we had one of those sort of debates, and I was just simply saying, well, the market might crap out, but if you took this bot, then we came back down to this level, you just walk away at scratch. And interesting how we dipped all the way down here, but we never did get back down to the bot entry level, and now we're ratcheting higher. So had you taken this bot long, we just had the move stop to trailing level hit. So now you can actually start looking for market structure to start trailing your stops. So that's kind of cool, really interesting to see. And sort of as we talked about just a moment ago, through this holiday long weekend, don't be surprised if we have some shenanigans through this. What's also interesting about this too is if you look at the 4-hour, and of course all the crypto bulls are going to love this. If you look at the 4-hour, we have this massive bot working here. There is the entry level, very sloppy. But in essence, we were talking about this on the site. Cute little bull flag here. And a breakout through the top, sort of what we talked about off of this chart, right? That weekly chart, wherever the hell it went. Here, if we break this top, then the bulls won. The bulls are in control. Woohoo! So we could clearly say that the bulls are in control. And actually, everybody should absolutely love this because CNBC just got stopped out. Is ETH taking off here too? What's ETH doing? Whoops. What did I do with my ETH chart? I had it on here. Ooh, look at yeah. Well, I don't know. This is stamp I'm looking at, so I'm not quite sure what market you're looking at. It's just 258.06. And Litecoin's catching a bit as well. Interesting how Litecoin has got this AB equals CD working here. So it looks to me like Litecoin wants to reach up into, and again, this is off a stamp. Looks like Litecoin wants to reach up into about 140, 150 bucks. So that's good to see. So, and I think this sort of makes sense what we were talking about earlier. No real signs of failure here on these higher time frames, so it's awfully tough for me to justify hunting shorts here. Yeah. And actually this should be really cool. Let's pop on over and look at all of them. So, oops. Yeah. Interesting how we're not getting the breakout on the algo. Algo did go bullish yesterday, but then it pulled back. So we'll see how this goes through the day, but looking uppy. That's nice to see. All right. So we took a look at your storm. We took a look at the basic attention. Nice bullish bots. You can see off of this massive 4-hour one. You had the balls to go long at 7,900. 88 is your move stop to scratch level. So it looks like that's probably going to be tagged just as we're talking here. Also, too, this should be a really good anecdote of the spreads. Let's see what the spreads are doing. Yeah, look at that. Interesting. So I've been talking to you guys in the public about this recently. In essence, as long as these things keep Wing out, making higher highs and higher lows, that's a really good sentiment vote in the marketplace. That's why I like to follow these spreads. So it looks like Bitcoin itself is leading the charge here. That's good to see. There's that Litecoin chart. The spreads are trying to kick in. So we might see some fireworks out of it. Looks like Litecoin's just coming alive as we speak here. And then there's the Ethereum. So lots of W's. That's very encouraging. And also, too, it looks like we're accepting back into contango. So rah crypto. Way to go, crypto. All right. On that note, why don't we leave today's conversation at that? Hopefully, I helped the level oneers answer a few questions about strategic planning and sort of big picture stuff. We got a really good, go away. Got a really good lesson in potential fractals and how you have to wait for the fractal signal to come in. Bull bear battle lines, and the bulls just won that battle, so that's good to see. No top in here yet on the weeklies, that's for sure. And we also took a look at a couple interesting names. This basic attention, not for me, but actually I do really like the look of this storm. If I was in a nibbling mood, this is the kind of market versus USD, right? This is the kind of market that I would definitely be interested in nibbling in. Maybe a little bit early for us to declare a bull trend-wise. All right, guys, why don't we leave that? I hope you enjoyed the offering. I'm not quite sure if I gave any value to anybody. I'm still sort of getting into the flow of doing these broiler chicken shows. But I hope you enjoyed that. So I'm going to go get ready. Breathe a sigh of relief. No breakdowns on crypto today. If anything, you want an idea, keep an eye on this Tron. Quite surprised to see when I just pulled this up. There's beautiful W in here. So it looks like crypto's catching a bid. That's good to see. Up and away. Play from a position of strength. Have fun with this. We're in sort of the fun time of year for crypto, so that's good. All the best. And the only thing left for good old Brian to say at this point is a big bye for now.